Hi, my name's Wes Soapbottom with Blue Rock Benefit Services, and I'm shooting this video for those of you lucky enough to be highly compensated and own your own business. Um, typically, the people would start what's called a SEP IRA. If you're, pretty much, let's call it a sole proprietor of the company. Um, it could be, you could be a realtor, an insurance agent, um, maybe an appraiser or something like that. It makes a lot of money and doesn't really have employees. So, typically the reason, the SEP IRA, you could put in up to 25% of your income and deduct the income from your current income, right? So you get a tax deduction for it, like you never made it, but you get it back later in retirement. Not a bad thing, right? So let's take a look at some issues where it may not be the best thing for you in retirement. Let me share my screen and we'll go over what some of those issues are and then some of the benefits of some of the things we can do for you as well. It may be better. It just depends, maybe good for some of you, but not for all of you. We'll talk about. So this is federal income tax brackets for 2020, and I believe in 2021 they haven't actually changed. The highest tax bracket is 37%. And how our progressive income tax works is this. So the first $9,875 we all make, we pay a 10% tax. Anything above that, up to $40,125, you pay 12%. And it works the same way all the way up to 37%. Right? So that's how that works. Now, let's look at income taxes, the brackets, or where we are historically in taxes. So, like I mentioned, the highest tax bracket right now is 37%. If we look at this, though, historically, we're actually in a low tax environment. And why is that a concern to me as an advisor? Well, if you're deducting money in a 37% tax bracket, going into retirement plan and you're saving on your taxes. Well, that's great, right? That all sounds wonderful. But what if taxes go up in retirement? We kind of sold a bag of goods in a sense, because what if taxes go up? Wouldn't it be better to have some post-tax money invested in your retirement account? And what I mean by that is a Roth. Now, having said that, let's go over taxes in another sense. So what the only way our government basically funds everything is by tax dollars. Well, let's take a look at the U.S. national debt. This gigantic number here on the left. If each of us taxpayers had to pay it off today, it's 200. Let's call it $224,000. Right. Well, I don't know about you, but I don't have $224,000 to pay anybody. But let's take a look at that. What the national debt will be in 4 years. So 2025. Now, this is grand. This is just a projection, but it jumps up to $365,000. So for this debt to get paid off, I believe taxes have to go up. So is putting your money all in a pre-tax investment a wise choice? I can't say, definitively, one way or the other, to be honest, but I think to be tax diversified, it might be a good idea. And then if we could also get you a little bit more you put into retirement plan as opposed to a SEP IRA, that may be a benefit as well. Now, there is what's called a solo 401k. So it's for an owner and an owner's wife. So here's the advantage of it. Now, like a SEP IRA, in this person's case, you can put in up to 25% of his income. 37,500 is 25% of 150. The difference is you can also put in a max elective deferral of 26,000. So if you put in up to 63,500 as opposed to 57,000 into a SEP IRA. Here's the other big difference is this deferral amount can also be put into a Roth 401k. So that money it'll be post-tax money going into it. So money you've already paid taxes on. But when you go to retire, that portion of your 401k will come out tax-free. So I think that's a pretty big benefit. One, you get to put a little bit more money into it. Two, some of it will be income tax-free coming out. And the third one, especially as somebody who's self-employed, that may be a big benefit as well, is if for some reason you needed to get to money in a 401k, there is a loan provision that is not in a SEP IRA. Now, there's one other option as far as getting post-tax money into a retirement plan. Now, some of you are going to go, "Oh my God, he's using those two bad words." It is a life insurance plan. Let's take a look at that. And I'm not proposing you do the life insurance plan, but just as an option, I think we should always look at all of our options. So the first thing is, in this case, they're a 40-year-old putting $57,000 in, which is the maximum into a SEP IRA. First thing is it buys $1.8 million of life insurance. So make one payment, this person gets run over by a car and is killed. $1.8 million goes to his or her benefit, in this case, his beneficiary. Now, if he paid in until age 65 and retired at 66, his income benefit per month is $17,223, income tax free the rest of his life. Now, the other benefit to the life insurance is it does come with living benefits. Now, if this person were to become terminally ill, they can get up to $1.4 million in the year prior to death to help pay for medical expenses. It also comes with a chronic illness benefit, which, let's call it the long-term care rider in a sense. So God forbid you end up in a nursing home, you can get up to $28,000 per month for that purpose. The other two benefits, critical illness and injury, if any of those things were to happen, you can get up to $935,000 a month sum, when it happens. So there's some other benefits to the life insurance. Now let's take a quick look at what the income is per year and how long it lasts. With this particular company, once you take the income, the lifetime income benefit kicks in, and it's a guaranteed number. So $57,000 going in, pay to 65. The cash value is built to 2.9 million. The death benefit, God forbid you die, is $4.7 million. 66, that's absolute worst case scenario. It's 66, so you start pulling income out of $206,000, $680, income tax free the rest of your life. And let me show you that. So the income continues to go out to age 98, and the illustration just cuts off there. This will actually run out to age 120. People are living longer. I don't know that anybody's going to live to 120, but let's take a look. Let's say this person lives to age 79, just for an easy number. Paid in 1.4 million, pulled out 2.8 million, income tax free, and this person dies. Well, what goes to the beneficiary is still $1.8 million. So it's a pretty big benefit. I'm not proposing anybody do all in this or all in the 401k, but just some options. If you have any questions, please feel free to give me a call. My direct phone number is 424-543-4584. I hope you're having a great day, and I hope to speak to you soon.